All right, welcome everybody. Today we are going to look at the law of liquidity. I don't think it's the entire law of liquidity, but from my own perspective, this is a bit of what liquidity is about. Okay, so in this lesson, we are going to look at two classifications of liquidity. That is external liquidity, which is external range liquidity, and internal range liquidity. So for a person to understand what internal range and external range liquidity is, he needs to first understand what a trading range is. We have two definitions of trading range, but we are going to look at the first one, the trading range. That is the distance between a higher high and a higher low. That we call a trading range, right? So, for instance, if you have a market unfolding, and then we see that we have a high and a low. Okay, our eyes goes to this particular low, right? So once this low is broken, we have a trading range. That is a lower high and a lower low. The distance between a lower high and a lower low is a trading range for now. So this is a trading range. Okay. So again, we have price pulls back into the range, the bigger range, right? And then drops. So the decision on where to pick a trade to join this particular downtrend would depend on the composition of the trading range. How liquidity is formed within this particular trading range would give you a point where you should take a trade to join the downtrend. Okay. So again, a major trading range has been formed. Okay. So now, internal liquidity refers to any highs or lows formed within the trading range. So if this is our trading range, this high and this low is our trading range, then any highs and lows formed within it is internal liquidity. So internal liquidity or internal range liquidity refers to any liquidity or any highs or lows that have been formed within the trading range. Okay, so this is internal liquidity. Right, so we have internal liquidity, internal range liquidity, all this internal range liquidity, and we have more internal range liquidity here. Okay, now external range liquidity refers to highs or lows outside the trading range, okay, including those that make the boundaries of the trading range. So if these are internal range liquidity, these ones are internal range liquidity, right? Then the ones outside it, including the highs and the low of the trading range, are external liquidity. So if price trades above this, we say that price has taken external range liquidity. So then any internal range liquidity in the previous move, that is here, that has not been taken. So instantly this one becomes external range liquidity, because to grab this, price needs to trade above this point. So external range liquidity are highs or lows outside the trading range, right? This is outside the trading range, if you are considering this to be a current trading range, including the highs or lows that form the trading range. So if this is a trading range, right, then this is external liquidity, this is also external liquidity, and this is also external liquidity. Now, okay, external liquidity are not to be broken, and a break of external liquidity against the trend is a BMS. So for instance, if price trades above this external liquidity, they have a break of structure. Okay. this is against the trend. This is in the direction of a trend. This is also a break of structure, BMS. Okay, but the meaning or the implication of these two are different. This suggests that we have a continuation. This suggests that this downtrend has ended and that we need what? To start looking for buys. Okay, so external liquidity, external range liquidity are not to be broken, but once they are broken, they suggest two things. The external liquidity that is against the trend, when it's broken, means that we have a reversal or we should anticipate a reversal. Then external liquidity that are in the direction of the trend, when broken, means that what we have a continuation. So for instance, if this external liquidity breaks, right, then it means that down here, we should be expecting some kind of wipe-off accumulation, right, or another break of market structure to give us a pullback. Okay, so when you take this trade, you know that we are in a downtrend and that we don't want to take profit above this, even though price may go above it, but you don't want to take profit here. But once price trade above this, right, then we look for a BMS again on a lower time frame, and you want to trade back into a point of interest here, but the intent is to buy, that the market has changed direction. Okay, so that is for internal and external liquidity. Okay, so now the characteristics of internal and external liquidity. We are saying that internal and external liquidity are characterized by the ability to hold or not to hold price. Okay, internal and external liquidity that have or that can hold price or reject price are called high resistant liquidity. So internal or external liquidity. So for instance, if this is my range, okay, this is internal liquidity. Now, internal liquidity that have the ability to hold price. If price comes here and this one has the ability to hold it, then this is what? A high resistance liquidity. Okay, so this becomes a high resistance liquidity. Okay, but if this doesn't have the ability to hold price, then it becomes a low resistance liquidity. Okay, so the characteristics is that it is either low resistance or high resistance. So internal liquidity, I read again. Internal range liquidity and external range liquidity that have the ability to hold or reject price, okay, are high resistance liquidity, HRL. And internal and external liquidity that do not have the ability to reject price are called low resistance. So an external liquidity can either be, so an internal liquidity can be either high resistance or low resistance. So if you look at this image, with price trading above all this, then these are what? Low resistance liquidity, and this is what? High resistance liquidity. In this case, these are low resistance, and this is a high resistance liquidity. Okay. So therefore, how do we identify which liquidity type can hold? That is which one is a high resistance liquidity, and then which one is a low resistance liquidity. How do we identify them? Because if there is liquidity that can hold price and there's liquidity that cannot hold price, then we should know how they are. Okay, so a low resistance liquidity is a high or low that was formed after price took out a significant demand or a significant supply or a significant high or a significant low. So what this means is that if I have a downtrend, a previous downtrend, right, and then price is coming here, okay, so let's say we had an uptrend, okay, and then we have a break of structure. You see, this high was formed after price couldn't break this particular low. Okay, because this is a significant high, a significant low, a significant high, a significant low, and a significant high. So in this uptrend, right? So if in this uptrend, these are significant areas, then price comes to this low and is able to reject it. You see, price couldn't break it at once. It has to go up before breaking it. Then this high becomes a high resistance liquidity. So when price is coming back to this level, to not be able to break this, right? Even if the trend is strong, it will hold it a bit before breaking it. So this one will hold price, right? This one will hold price. But if it had broken this level before forming this high, then this becomes a low resistance liquidity, and then it will trade above it. Okay, so and then the other one is the opposite. So we look at it from in the image. So for instance, this, we have an uptrend. We have an uptrend here. This is a higher high, a higher low, a higher high, a higher low, a higher high, a higher low. And then you have a BMS, break of structure. Price has broken through the last lower high, the last higher low, sorry. Okay, price has broken it, so we have a BMS. Okay, so after BMS, we have RTO. Price came back to a point of interest and dropped, and then price is coming back. So when price is coming back, this area, okay, because it was formed after price took this low, this price will trade above this because it's a low resistance liquidity. So if price breaks a significant low or high or significant supply or demand zone, so it depends on how you understand this. If this is a demand zone to you, okay, it is a significant demand zone. From after that, we define what a significant demand zone is. So it's a significant demand zone, and price broke it before giving us this pullback, this retracement. So the high of this retracement becomes a low resistance liquidity. So low resistance liquidities are highs or lows that will not be able to hold price. So this one will not hold price. Okay, so with this, you look for a point of interest if you want to sell above this level. So it could be a fair value gap here. It could be another mitigation block or another block or any other point of interest above this particular level that you trade. But you know that price will trade above this. Okay, so for instance, if you had a BMS here and you had a reason to take a trade here, okay, your target will be this low resistance liquidity because it will not, this is where you put your take profit above or at the level. Okay. Okay, so we said after breaking the low resistance, price will reject from an FVG, a fair value gap, or any point of interest above it. Now, a high resistance liquidity. So, for instance, we have the same pattern, right? But price was not able to break this significant zone, this significant low, this significant demand zone. Price couldn't break it, and it gave us what? A pullback. Now, logically, let's look at the logic behind it, right? This area could not be broken because there was not enough strength to break this. But after the pullback, this means that this area is strong. Because there has been rejection, this area is strong. Look at this speed, could not break this. Then what happened here that this was able to break? You get it? So it means that here there was active participation. Here, the sellers gain more strength to be able to break this. They didn't have enough strength from here to break this, but they got more strength here. So this becomes a significant zone. So when price is coming to this zone, you know that price will hold. Okay. So if price does not break a significant low or high or significant supply or demand before a pullback, the new swing, this swing, becomes what? A high resistance liquidity. So a high resistance liquidity, right, will hold price. Okay. this will not be broken on the first attempt, okay, and that will reject price. So if even you know it is a buy, right, you know that when it gets here to pull back before going. All right. Okay, so now the combination, for instance, this is still the same chart that we saw, right? We have the main swing. So these are range, our first range here to here. And between the range, we have swings. Okay, so first swings are internal liquidity. They are all internal liquidity, but some of the internal liquidity are high resistance and some are low resistance. This broke this low, this significant level. See, high, low, high, low, high, low, high, low, right? So this level held price, sent price back. This level broke price. Okay, so when price is coming back, you know that it will not break this level, but it will break this level. Okay, so this is it. So a point of interest here, there are a lot of point of interest. So a point of interest above the low resistance liquidity will give you the entry. Okay, so if you found a way of entering here, right, and you are looking for a pullback within, you are targeting liquidity. You're targeting liquidity, because these are all low resistance liquidity. Okay, and the same scenario applies here. In here, okay, this one held here. Okay, it held here. This one also held here, and then it broke. But we'll go deeper into it and look at some examples. Okay, so here, this Euro USD trade, right? So now we saw that price was going up. This is a higher low, a higher high, a higher high, a higher low, right? This is not a significant level because this wasn't formed. This is not formed after a higher high is created. This is a higher high. This is not a higher high. So this is not a significant level, right? But if you take this small move up, this is significant, higher high, higher low, higher high, higher low, higher high, higher low. So in this move, this is not a significant level, right? So now this is significant. This is also significant. So price came and held at a significant level, give us a pullback, right? And then broke the level. Now, this level is significant because look at, if this is a whole demand zone, if this entire thing is a demand zone, price rejected it once, right? Came back, tested it again, right, before breaking it. So far as this level has been able to reject price several times before breaking, the level that broke it is what? A high resistance liquidity. Okay, so we had a high resistance liquidity, and then when it broke the level, it gave us a pullback, which is a low resistance liquidity. So above this low resistance liquidity, you have a fair value gap and then a hidden supply zone, right, somewhere here. So price trade into it and then it drops. Okay. Okay, so this is another example. We have, when we took this particular one, right, price broke out of this level, but within it, okay, we saw this high, this lower, this higher low, and this higher high, this higher low. That couldn't make another one, but you see, it rejected this demand zone, significant demand zone. First rejection, second rejection, third rejection, right? And formed this particular high before breaking it. So this high is the one that caused the break of this particular significant level. So after breaking it, we had a pullback here. So this pullback was formed after price broke a significant demand zone. So this becomes low resistance and this becomes high resistance. In between these two, if you find a point of interest, right, you can have a good trade. But we just don't take the trade from here and then leave it like that. We have a way of taking the trade on the smaller time frame. We watch certain things. For instance, at this level, I can talk about waiting for a smaller time frame break of structure or a smaller time frame Wyckoff schematic. Okay, because in this trade, there was a distribution schematic on the 1 minute chart, right? That tells you that okay, the market is about to go down. At the same time, there was another how do you call it, diagonal triangle being formed on the 1 minute. Also tells you that price is about to go down, ending diagonal. Okay. All right, I have few minutes left. Okay, so now there is a way you can use this, in a simple way you can use this. We look for a sponsored candle, okay, the sponsored candle, and then we are seeing that it's anytime price take liquidity, the highest candle, whether bullish or bearish, is what in the swing is what we call a sponsored candle, right? This is because smart money only is the only one who has the power to work, blah, 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 all those things, right? But what it simply means is this. Okay. A sponsored candle is a candle that has taken liquidity. So we see one here, there was this previous high. Price has traded above this previous high. By the end, the effect of it is what matters. When it took that particular high, it came and broke structure. So with this, okay, this particular candle, when price comes back to that level, it's a place you want to be a seller. All right. So if we want to use a sponsored candle, that a candle that has taken liquidity, or an order block that has taken liquidity, to frame the trade on what? The high resistance and low resistance liquidity. Okay. So for instance, this one case study, right? In this particular chart, you realize that this candle has taken liquidity here. It traded above all this. This took liquidity, but there was no significant effect. It couldn't close below this low. Okay, so this is not, we cannot consider this. This also traded above this, but couldn't go below, it couldn't push price below this level. So we cannot consider this. But watch this. Price came to this one, took liquidity, and then went below all those levels. Okay, so because of that, this can be considered as a sponsored candle. Okay, so if this is a sponsored candle, then we are looking for price to come back to it and trade down. Okay, but in this particular case, we had a bullish momentum, right? So we are still using it, and then you see how you can use it to frame your trade. Okay, so this is a 12-hour sponsored candle. So we went to the smaller time frame. I think this is a 1 hour chart. Okay, and so this area that was marked, this area that was marked is this. Okay, so within this area, we are seeing a high, higher low. Okay, this is not a higher high, didn't go above this. This is a higher high, a higher low, and then a higher high. Okay, so making this low a significant low. Now see what price is. Price came to it and rejected it. So this makes this level a significant level, right? Because price came back to it and rejected. There was a rejection, first rejection before breaking it. So when it broke, it gave us this pullback. So this becomes a low resistance liquidity. This is a high resistance liquidity, and this is a low resistance liquidity, right? So it gave us a range of 27 pips, meaning that if you decide to sell here, your stop loss is here, you have a 27 pip stop loss. Okay, so 27 pip stop loss, which is too big, right? Which is too big, and the intention is to reduce our risks so that we increase our reward. Okay, so now if you go to the 1 minute, I think 1 minute chart, right? This is the same range, the same area. Okay, so on the high resistance liquidity, this high resistance liquidity, we saw this. So we can break it down to this. We have a new high resistance, because if you look at this demand zone, this high, low, higher high, higher low, higher low. Wait. Higher high, higher low, higher high, higher low, and higher high. Okay. This, right? This level, even though not part of this, okay, because if you take this move as a trend, okay, and go to a smaller time frame again, maybe 30 seconds, you'll be seeing highs and low like this. Okay, so this high, this particular low, this particular demand zone held price. So price held once, sorry, broke price. So we broke this level and then went up. And so if this is it, then this area, which has already been mitigated, becomes a high resistance liquidity, because we don't expect to see price trade above this, right? Because one, you see, that high was created after price traded inside the zone. So we created this high. So now it reduces the trading range breaks to this. I didn't write it on it, but this is the risk. The risk has been reduced from down somewhere to this level. So our entry is here, and then our stop loss will be above. Okay, so now this is what it gave us from the whole area. This is the low resistance and then the high resistance. It gave us an interest area of this small margin. Okay, price enters it and drops. Initially for this trade, our expectation was that price would trade below these levels because of the break of structure that happened here. Okay, but it was more of a buy trade, so we were stopped out. I think, yes. So now, if you are targeting, look at this. This on the downside, this low, if it ends, okay, we are going to rejoin with the same link, and then for questions, right? We are going to join with the same link for questions. I think I'm all right, I'm done, right? So this low was created after price took this significant high, right? So this becomes a low resistance. So when price is coming back, if you take this one, and then we move up. Okay. Anyway, so that will be all. I don't know if you have questions.
Oh, thank you very much.
All right. Any question?
Hello?
Yeah, I can hear you.
Yes, so my question is, what happens if price takes out a high resist liquidity? Please, did you get my hello?
You said, come again, ask your question again.
Yeah, my question is, what happens, or can we make any meaning if price takes out a high resistance liquidity? If it
Yes,
takes it out,
price
does it mean
can.
that probably the trend has changed, or
No,
like
it doesn't
what can we
definitely
make out
mean
of
that
it?
the trend has changed, right? So now, using the high resistance liquidity doesn't mean that, okay, because this is a high resistance, let me find one. because this is a high resistance. For instance, this is a high resistance liquidity, this particular one, this one, because price, it was a rejection at what? A supply zone. Okay, give us a pullback. Okay, it doesn't mean that you should trade all high resistance liquidity. You have to first define the trend and then trade in the direction of a trend. Okay, so high resistance liquidity can be broken, but the thing is that 80% or 70% of the time, high resistance liquidity will give us a rejection before it is broken. You get my point now?
Okay.
Yes, it will give us a
Yes,
rejection before it is broken. Any other question?
Okay.
Hello, sorry, I was a little bit late into this webinar, but you just said something that really makes sense to me. By finding higher resistant liquidity, that you need to follow the trend.